So every aspiring investor should know that there are two main schools of thought when it comes to investing, those being those who are value investors and those who are growth investors. And I'm going to describe both of these groups in this video, and you're going to probably determine what kind of investor you are or what kind of school of thought you want to research more about and see which one you like. I'm going to say some pros and cons, talk about some characteristics, some ratios that they look at. So with that said, let's go on with the rest of the video. If you're interested in investing in stocks, I highly recommend you use Webull as your broker. They actually have a promotion right now that gives you 2 free stocks if you sign up for them and deposit at least $100. Those 2 free stocks can be valued to up to $1,400. So what are you waiting for? Get that free money for just signing up and depositing. There's a link down in the description for just that. So the first type of investor I'm going to talk about are those who are value investors. Value investors are, as the name derives, looking for value. They're looking for good deals in the market. The most commonly known value investors are probably Benjamin Graham and then his very well-known disciple, Warren Buffett. They like finding companies that have fallen out of favor with the public, maybe because of something like bad PR or maybe because of some rough earnings reports here and there. However, they, through their own calculations, have determined that these companies are actually worth way more, and they're willing to hold these investments for a very long time until all other public investors and institutions realize that these companies are actually worth way more. And then that investment that they made when those companies had fallen out of favor will grow exponentially. Being a value investor generally involves investing in the long term and being able to wait. Value investors wait a lot. They're going to be waiting for years, sitting on a lot of cash, looking to find those excellent deals. Once value investors invest in those really good deals, they're going to hold them for years. Warren Buffett rarely exits positions unless they've completely changed or fallen out of favor under his own criteria. Generally, the metrics that value investors look at are price earnings, and then they enjoy also dividend payouts and especially the book ratio, that being what is the company worth according to their balance sheet, and then does that match what the company is worth according to the stock market. If the company is worth a lot more according to its balance sheet than according to the stock market, then that could provide an opportunity. That could mean that a company is not as valued by the stock market as it truly should be. In order to be a great value investor, you're gonna have to love numbers and you're gonna have to be willing to go inside all the reports, all the fundamentals of the companies you're analyzing in order to find those 1 and 2 really good deals in a sea of companies out there. And that's essentially what Warren Buffett has mastered. He has his own criteria, he has his own formulas, and he is constantly crunching numbers based on companies' reports in order to find those which are really good companies, and then he basically just goes all in on them. If you don't want to go through the process of finding all of these undervalued companies yourself, you can also invest in a value-based ETF or mutual fund. That is a fund that is managed by people who are value investors, and they give that as an option for you to invest in so you can get some exposure to that strategy without doing it yourself. Value investing tends to be not that volatile actually, since theoretically, if you're already buying companies at a severely low price, then even if the market turns red, those companies may not actually suffer as much as other companies which were overvalued before and now are going down to their fair value. Value investing, however, is known to suffer or lag behind a little bit when there is an extended bull market, such as the one we saw from 2009 to 2020. That is because other companies are going to grow at such a quicker rate, and it's going to be hard to find really good deals when there's been a bull market that has been increasing the value of companies for so many years. And that leads me to the second type of investment, which I'm going to talk about today. That is the school of thought of growth investors. And as the name implies, growth investors are looking for growth. They're looking for companies that have been steadily growing in their earnings, in their profits, in their PE ratios, and they're looking for those companies that can sustain these growth rates, that can actually keep growing and giving them exponential profits over the long run, especially during a long bull market such as the one we just saw. Growth companies are not cheap. If you look at stocks such as Apple or Netflix, they're going to be trading at over $200 or $300, which is way more than the average stock. Their PE ratios are also going to be exorbitant sometimes. The fact is, growth investors don't care as long as these companies can keep proving that they can keep growing their profits and their investments. In fact, a lot of growth investors shun dividends. The fact is, they would rather see that money that would have otherwise been paid to shareholders reinvested back into the company to grow even more. That's among the reasons why a lot of tech companies don't pay dividends and why the tech sector in general is highly valued by growth investors as opposed to value investors who usually shy away from tech. And just because a company is maybe overvalued by the stock market doesn't mean that it doesn't have room to keep growing. That being said, once again, they're overvalued. And that means that if the stock market takes a strong downturn, those companies are going to be way more volatile and may actually go very low in price, even more than value stocks. Once again, you don't have to worry about finding the growth companies yourself if you don't want to. You can find growth-based mutual funds or ETFs that are managed by growth investors and offered to you. These funds are probably going to be more expensive than the broader markets and a little bit more volatile, but hopefully they're going to carry a lot of potential for growth. If you're interested in learning more about value investing, I highly recommend reading The Intelligent Investor by Benjamin Graham, which is considered basically a Bible of value investing. If you want to learn more about growth investing, I highly recommend reading Common Stocks and Uncommon Profits by Phil Fisher, where he gives very clear steps on how to identify a growth company that can even be a very commonly known stock, but that can give you so many profits over the long run. The link for both of these books will be down in the description. Now, I want you to tell me in the comments, what kind of investor are you? Are you a value investor? Are you a growth investor? And why do you like that sort of school of thought more? And also, if you like this video and you want to see more content like this, don't forget to like and subscribe. It really helps me out with the YouTube algorithm, and I appreciate each and every one of you. With that said, tune in for more content later, and I'll see you on the next one.